FBN Quest Manufacturing Purchasing Managers Index for Nigeria showed a recovery to 54.6 index points in the month of November from 51.2 points in October. The recovery is in line with the third quarter manufacturing GDP figures reported by the National Bureau of Statistics, which showed a slower contraction in the sector. Chinwe Egwim, an economist at FBN Quest Merchant Bank, joins me now to discuss what's playing out with the PMIs for the month of November. Thank you so much for your time, Chinwe. And let's get into the headline PMI readings. We see that we're regaining some lost ground here. Can you speak to the drivers here?
Yeah, thanks, Kenneth. The headline reading rose from 51.3 to 54.6 in November. Now, 4 of the 5 sub-indices recorded increases. The increases recorded in November marked a recovery from the disruptions from the protests, that happened the previous month. And it can also be attributed to the pickup in demand due to the upcoming festive season. Furthermore, the relaxation of restrictions and lockdowns has resulted in resumption of businesses. I think it is safe to assume that manufacturers are slowly adapting to the new normal that has been triggered by the COVID-19 pandemic. Supply-side constraints eased a little during the month as there was better access to raw materials and production inputs.
All right, now let's get into what's playing out in the manufacturing operating environment in Nigeria. And this time we saw that in the month of November we had a fuel price hike, and also we saw the electricity tariffs come on board as well. How did that play out for the manufacturers?
Well, the operating and business environment remains somewhat hazy based on some of the things you just mentioned. I would speak on the reading for employment. That declined below neutral to 49.5%. And it's often the weakest link. So because GDP per head has not been positive since, let's say, Q3 2015, we cannot be surprised that companies are reluctant to take on additional labor. And, of course, the operating environment is seriously affecting that ability to take on additional labor. According to the National Bureau of Statistics, the unemployment rate, the latest that was released for Q2 2020, was as high as 27.1%. And so, yeah, the operating environment remains hazy.
All right, so let's get into the recovery we're seeing in the segments of the manufacturing, so food and beverages, for cement, and even for textiles as well. What's that playing out from your readings this month?
Okay, I didn't hear you properly. I don't know if you asked about segments within the manufacturing sector. Can you please confirm?
Yes, what's playing out there?
Okay, well, so the sector declined. The Q3 national accounts released not so long ago showed that the sector contracted by minus 1.5% year-on-year, and that's compared to minus 8.8% in Q2. Now, its largest segment, which is food, beverages, and tobacco, that grew by 5.6% year-on-year. The relaxation on movement restrictions, as I said, and lockdowns in Q3 contributed to a pickup in not just economic activity, but also demand. And this supported the relatively positive performance seen in this segment. As for cement, although not at optimal levels, construction activity has picked up when we compare it to the second quarter of this year. So the cement sector also posted some growth in Q3.
But Chinwe, when we look at the FX crunch that we've been witnessing and the pressures on the Naira, though, how is this impacting the manufacturers?
Well, the current economic downturn emanating from lower oil prices and the virus spread has resulted in FX policy adjustments by the CBN. Of course, we all know this. Both FX, illiquidity, and pricing pose additional challenges for manufacturers. Now, according to some manufacturers, FX is more accessible in the parallel market, but the transaction volumes are not sufficient to cover their necessary dollar-denominated costs. Now, some local manufacturers are considering passing on increased production costs to consumers, but they also worry that they could lose market share to their foreign competitors due to their relative affordability. Given Nigeria's heavy reliance on imports for both inputs and finished products. Boosting domestic production is now imperative more than ever. The FGN has announced some relief packages that should assist local manufacturers. However, the impact may be minimal since structural issues are yet to be addressed.
All right, they're still looking at your report. Yeah, I want to know also what's playing out with your reading for employment. And what are manufacturers saying, and are they looking to get more people into their workforce in the near future?
Okay, so as I said earlier, the reading decreased to 49.5 in November for the employment sub-index. Now, the proportion of no change responses accounted for 89% of the total. That's a whole lot. Generally, companies are still maintaining a cautious approach towards taking on additional labor due to the economic downturn. There's a report that came out from the MDS, and that report was done in collaboration with the World Bank. I think that's the COVID-19 impact monitoring report, which showed that based on their survey, the share of respondents who are working has stabilized at about 85%, and that's close to the pre-COVID level. So I think what we're seeing is a return to pre-COVID level, but not essentially a big increase in the labor force or the labor or employees within an organization. Employers are still being cautious with taking on additional labor.